bond market is telling us we actually might be in a recession already. Investors don't believe inflation or debt can be controlled no matter what the Fed does at this point. Now, you might be thinking, Andre, I do not care about bonds. I don't invest in them. I don't buy them. But bonds run the world. They set the interest rates for the cost of things like mortgages, loans, and even the value of our currency. And it's not just happening in the US, it's happening across almost every G7 country around the world. In the UK, for example, the yield on the 30-year bond called the gilt just went up to its highest level since 1998. In Japan, their 30-year government bond yield hit a record high, and it's been moving almost at the same rate as the price of gold, which is something that should never normally happen. In Germany and France, their long-dated bonds are also at multi-year highs. And here in the US, the same thing. Even though the Fed is telling us they are preparing to lower interest rates, the opposite is happening. The yield on long-term bonds is going up. Everywhere you look in the world today, the long end of the bond market is going in the opposite direction of where we want it to go. And the thing that's interesting is that normally, when economies get weaker, central banks cut rates and the bond market follows. The rates also go down. That's how monetary policy is supposed to work. But right now, it's not.
This is the special situation we're in, which is we have two-sided risk to both of our goals.
And if central banks are losing their ability to control interest rates, that's usually one of the first warning signs that the world economy is in trouble. Now, I know that all of this is insanely complicated,